No one wants to pay more tax than they need to, and no one wants to get into trouble with the taxman. So today, Ken Race and I are going to interview Rob Thompson, Assistant Commissioner of Taxation, who's got a front row seat into the intricacies of our tax system, and he's here to help unpack some of the complexities that property investors face when putting in their tax returns. So welcome to another episode of the Michael Yardney podcast, where we help investors gain clarity amongst the confusion of the many mixed messages regarding property so they can develop financial freedom. Now, today with Rob Thompson and Ken Race, we're going to be discussing the Tax Department's data matching program for property investors, where they get the information from. We're going to talk a bit about the tax gap and why it's relevant for property investors, the PAYG system. That's something a bit different. The difference between deductible repairs and expenses, initial repairs and improvements, and the ATO's new borrowing expenses calculator. So if you're wondering whether you're doing all you can to optimize your tax position, you're in the right place. Let's get into it.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Welcome back to the show, Rob. Today we're also joined by Ken Race, Director of Metropole Wealth Advisory. Now, Rob, this is the third time you've been on the show, and there's a lot I'd like to cover. So let's start with self-assessment. It's one of the things that's very important for property investors and tax people who do their tax returns anyway. Let's explain, what does it actually mean?
Yeah, thanks, Michael, and thanks for having me on. So first of all, we know that most people want to do the right thing with respect to their tax. And more than 96% of tax paid is as a result of voluntary compliance with the tax systems. That means people pay the right amount of tax at tax time when they lodge their tax return. But self-assessment means that when you lodge your tax return, you declare and we accept the income and expenses and all the information that you've included in your return, and that's complete and accurate. So it's the responsibility of the taxpayer, the individual, to ensure that the tax return and the other forms comply with taxation laws. Even where you're using an agent, you are still responsible for the information that is on the form.
Thanks for that, Rob. But I suppose it doesn't mean that as a taxpayer we can just willy-nilly put anything in, because there are rules and regulations we still have to follow. So could you just comment on that, that we really can't just write anything down without some substantiation or checks?
Yeah, that's right, Ken. Definitely not. You can't claim anything that you just want. You know, we have a lot of checks and balances and data from many sources that we compare against what people put in their income tax returns or information in other returns or forms they file. And where there are discrepancies, we'll review it and we might come and ask the person to explain the difference. So our checks and balances are also evolving over time and are becoming more sophisticated with additional analytics and information. So we check against things like third-party data that we get in, such as income due from bonds retained by a landlord at the end of a tenancy. And we also compare the taxpayers' common attributes to determine outliers across their information and expenses compared to taxpayers that have a similar set of attributes.
And I think those checks and balances, as you said, is very important, because with the increase in information technology and AI, the ATO has access to the records of many of these other businesses and corporations that landlords interact with. So could you tell us a little bit about the data matching that you do and what type and where you get it from? You mentioned one thing before, but there's probably a longer list.
Yeah, Ken. So there's actually we get several information sources that we use as it relates to property investments. So we get landlord insurance data, which provides us things like insurance payouts that the landlord may have received, which obviously need to be reported as rental income, but also the landlord insurance premium expenses. So we have some understanding about the expenses that should be claimed there. We get residential investment property loan data, which provides us with interest and borrowing expenses from investment loans. And we get rental bond information, which I mentioned a minute before, which tells us the details of any bonds that have been paid to the landlord, and whether the landlord's retained that bond and kept as assessable income. We have data from sharing economy platforms, which provides us information on short-term providers or people that are renting out through those platforms, and that includes income information, that includes fees paid to the platform, which are obviously also a deductible expense. We also get property management data, which provides us with rental income information, but also provides information on the tenant's contribution towards water rates, but also expenses related to property management fees, and other expenses that are kind of handled by the property manager, which might include things like your body corporate fees or your repairs and maintenance. So we receive this data from software providers who are required to give us these details around the rent and the expenses for residential rental properties that are managed by a property manager. And so we're constantly working towards how we can use this data really to help assist people as well, right? So how can we assist people so they get it right? We know most property investors out there want to get it right the first time. And so we're not just looking to use this data to try and identify where there's an issue, but we are thinking about ways we can help rental property investors really get it right the first time when they lodge.
Rob, I know you get data from a lot of other sources as well, including the gig economy and things. But if we stick just at the moment to property investment and property management, you've got, a lot of this property management data. You must have some big computers somewhere. Do you have any comments about what you found once you started to analyse all this data?
Yeah, really good question, Michael. I mean, we do have a lot of computers, more than just the laptop that I'm doing this podcast off. But looking at that data, we've conducted some checks using that data, especially the property management data, and we found some actually really interesting things, which is kind of why we try to make sure people are aware of these, right? So one we see is that landlords get confused between the difference between gross and net figures for both short-term and long-term rentals when they're filling out their tax return. So gross income is the total income that you've received before you've taken any expenses out. But what we see is instead of reporting the gross income on their tax return and claiming the expenses separately, we see some landlords get confused, include the net expense, and then they claim all their expenses again. The net income, and then they claim all their expenses again. So they're kind of...
It's really double dipping, isn't it, Rob?
It's kind of like, it's good party etiquette, Michael. You go to a party, you don't double dip your chip. So we just want to make sure people don't double dip their rental expenses, right? So that's definitely one area where we're trying to just make sure that people understand in their tax return, income's the gross income, and then make sure you report all your expenses separately. We've also noticed, the other thing we've noticed through looking at this data is that sometimes the property is owned by more than one landlord, and only one person's reporting the income and expenses on their tax return. So what's required is all owners need to report the income and deductions on their tax return related to that rental property, depending on their legal share in the property. Now, that can be different depending on whether it's a tenant in common or joint ownership, but it's really important people where you've got joint ownership of a rental property, understand the legal ownership structure related to that, and then include the income and tax expenses on their income tax return consistent with that.
Clearly, people can't now hide rental income, can they? They can't pretend they didn't get rental income coming in, considering that you're getting the information from the property managers who legally correctly have to keep audited accounts.
That is correct, Michael. We have seen, I think through the data, we have seen some taxpayers that have failed to report any income related to their rental property, even where they're having the property manager look after the place. So obviously, they do get a please explain from the ATO where we do see that.
I can imagine. One of the things I know that property investors have a little bit of confusion about is the difference between repairs and maintenance and capital improvements. I know when they buy a property, often they've actually got to do it up a little bit, get it into better condition. Hey, maybe I'll just renovate the kitchen beforehand or the bathroom so I get better rental return. And while there could well be good investment fundamentals for doing that, I guess it makes a difference as to what you consider. So it is a repair, it is an improvement, but how do you class that tax wise?
Look, Michael, it is one area we do see some confusion, right? And understanding the difference between like repairs and maintenance, which you can claim on your tax return straight away, and something which is a capital expense, which needs to be claimed over a period of time, it is an area where we see property investors getting confused. And so there is a lot of information on our website, that helps people to understand the difference between those. But basically, a repair is something that is done to remedy a defect or damage done to the property from general wear and tear from your tenants. And so you're just really kind of bringing it back to its basic functionality. The cost of repairs and maintenance obviously can be claimed straight away in your income tax return. So you can claim that general repair straight away. So for example, you got a cracked tile or one or two cracked tiles in the bathroom, Michael. You replace them, that's
Yep.
a repair. You go, actually, you know what, I'm going to remodel the whole bathroom. Then that's capital in nature, and you've got to claim that over a period of time as it's considered a capital works.
We always recommend people get a depreciation schedule from a qualified quantity surveyor. Accountants understand the principle, but they're not really the right ones to do this. So therefore, there are some things you can claim over 40 years, the shell of the building, and there's other things that you can claim over a much shorter period of time.
That's right, Michael. And so having good records from the start when you buy the property, and then continuing that good record keeping throughout your ownership time, can help you both year to year on what you can claim in your income tax return, but actually also is then useful and critical in when you work out your capital gain or loss when you dispose of the property. So really good point, and reminder for everyone around keeping good records and having a system from the start. And we talked about capital works. So capital works, those things that aren't repairs and maintenance, are typically required to be depreciated at 2.5% of the value of that over 40 years. And so this means that, you do need to keep that schedule, and it's important to keep the information around this. And that includes also when you're adding or altering the building, then that's also capital in nature. So you put a new pergola out the back of the rental property, then you need to be claiming that over 40 years, as of things like, remodeling the kitchen and other things, they're over 40 years at 2.5%. So really good record keeping, having all those records and keeping all those records is really key.
And Rob, that really brings us to a very interesting point, because we talk to our clients a lot about the business of tax. It's quite a serious thing, and you've got to know the rules of tax, and you've got to find people that'll help you. And the nuances in those tax rules are critical. And that's going to be my next question, because it's one thing saying I've spent money, is it a repair? But you've also got to know that the time that you spend that money could change the way you have to put it in your tax return. So if you have to repair something, when you initially buy the property, you treat it differently. So can you explain a little bit about the difference with these expenses, the initial expenses when you buy versus when you spend that money well and truly into a lease?
It's a really good question, Ken, and one where we do see some confusion. So when an investor buys a property before they rent it out, and they need to kind of do some repairs to get the tenants in, they're called initial repairs. And they are treated differently to your normal type of repair. And this is because you're not fixing anything that the tenant's done, but you're actually fixing it beforehand, or it was there beforehand, even if you fix it later. So repairing damage that existed when the property was bought, whether you knew about it or not, is likely to be an initial repair. And in most circumstances, those expenses are considered capital in nature, and they are generally depreciated over 40 years at 2.5% per year, unless it involves some second-hand assets. And as I said before, capital works and capital allowances, those things can also factor into your capital gain tax calculations when you dispose of the property. So once again, really important to have good records.
And I suppose it's important to also know the size and what you're actually spending. So it may not be a repair, but it could be a bigger capital item where you actually have to depreciate. And by that, I think a lot of our clients understand, and the audience might understand, you can't write it off immediately, a depreciable item. It's got to be spread over the life. But that could also occur at the time of the initial purchase. So you spend a big lot of money, then obviously you have to write off that expenditure over a much longer period of time. So can you explain a little bit about that depreciating asset and how you see it being treated correctly?
Yeah, again, so there's once again, there's you've got your repairs, you've got your general capital works, and then you've got this class called depreciating assets, and they also they're assets which are capital in nature, and they are claimed under our capital allowance rules, and they're depreciating assets, though they have an effective life, and so the lifespan of that is how long it's expected to last, and so you can claim it over the period of time. So if you've got an effective life of something that's 5 years, you can claim the cost of the depreciating asset over the 5 years. The deduction may be limited, though, to whether it's a new or second-hand depreciating asset, and that test depends on when you've purchased the property. So have a look at the ATO website or get some advice from a registered tax agent. They'll be able to kind of explain that to you. But we do have some fairly comprehensive lists of depreciating assets in the rentals guide on the ATO website. It shows you how long things can be claimed for. And we've added these, I think we're going to add these into the resource list for the podcast to make it easier for everyone. But there are a couple of things to remember with respect to depreciating assets. One is you can only claim new depreciating assets. And if you buy an existing property, the assets in there are considered secondhand, along with the other assets you might have installed, but were for somewhere else. So if you kind of take your dishwasher out of your own house and stick it in the rental property, it's considered secondhand. And so you can't claim any deductions for these. However, if you replace a depreciating asset as an initial repair, the decline in value of that new asset can be claimed. And of course, if you buy a new property, then the installed depreciating asset, all the installed depreciating assets like the air conditioner are all considered to be new. So it does get a little bit complex depending on the property, when you've bought it, whether the asset's secondhand or not. So definitely something that all investors that are looking to buy a property should probably look at and think about even before they've bought the property, so they understand the tax rules, so they understand what they can and cannot claim, because that can obviously impact your cash flow as well.
And I suppose keeping good records of all these things is important. Your invoices for things, the time that you spent the money, the date that you spent money on, they're all things that the ATO can call on to help prove your position. So critical to keep good records and paperwork.
That's correct.
Well, it's much easier nowadays, Ken, isn't it, with the various programs, and you can use your phone to take pictures of the invoices. But I guess it's long gone from the old days where one used to go to the accountant with a shoebox full of invoices and hand them to him and say, here's my tax return. One of the things you don't necessarily get an invoice for, Rob, is your interest expenses. I mean, over the last couple of years, we all know our mortgage costs have gone up. It's probably the biggest regular recurring expense for property investors. How does the tax department keep track of that?
So I did mention, Michael, earlier that we do get some data around this, so investment property loan data. But overclaiming interest is kind of a problem in an area where we see rental property investors not getting it right. So interest that you pay that relates to your rental property for generating income is obviously immediately deductible, but only the interest on the loan that is, or only the part of the loan that relates to the residential property and the investment property. And so this means, like, if you've taken out the loan for more than one purpose, say, for example, if you use the money to buy a new car or go on a holiday with the family, or renovate your own house, but you've also used that to kind of to purchase or fund part of the purchase of your investment property, you need to apportion the interest between the private part and the part that generates the income, which is the part that you've used to fund for.
That gets very hard down the track, doesn't it? So we definitely don't recommend that. And a good finance strategy is to separate your private loans from your business loans, especially since sometimes you pay a bit off and if there's principal and interest. But from what I understand, Rob, the incorrect reporting of interest, I know we spoke about this last time, makes up a huge percentage of what you call the tax gap, doesn't it?
That's right, Michael. So incorrect reporting for interest expense accounts for 42% of the total tax gap for rental properties, and the total tax gap for the rental properties is 1.2 billion. And so,
Now, you taught me last time when we spoke what the tax gap is, but some people may be listening to this and haven't actually heard that expression before. Tell us what it means.
So the tax gap, Michael, is essentially the difference between theoretically what everyone should pay if they were 100% compliant with the
Yeah.
tax laws and what people actually do pay. And so,
And there's $1.2 billion that's not being paid. And on that basis, then I guess all the other Australians are having to contribute more to make the world go round.
yeah, I mean, I think the easy way to think is that's $1.2 billion, Michael, that doesn't fund essential services for the community. It's not the ATO's money, it's the community's money we're collecting. And so interest expense is obviously a large bit of that. And I think one of the things, or incorrect interest expense apportionment is one of the issues there. And one of the issues there is people need to realize as well, if you've got a mixed use loan, you've got to actually apportion it for the whole life of the loan as well. So some people think, well, if I've paid the amount of the loan down that was equal to my car, the rest is deductible. It's actually not. You've got to apportion it for the whole period. And so this is where it gets tricky, and this is where we see mistakes, and this is what kind of drives the tax gap.
And I suppose, Rob, you've also got to match, I suppose, that you borrow money, you pay interest. But when you borrow money, there's also costs associated with that borrowing. And that might be to a bank or to someone else. And you have a certain rule, if you like, of how to claim those borrowing expenses. So can you just explain to the audience a little bit about claiming those borrowing expenses?
Yeah, Ken. So obviously, borrowing expenses, start of a loan. So if your borrowing expenses are more than $100, which I mean, realistically these days is pretty much everyone, right? You need to calculate and spread the expense of those costs over a 5-year period, or the term of the loan, whichever is less. So odds are as well that you don't kind of buy a property on 1 July. So you need to pro rata that first year and then the pro rata the last year over that 5-year period. So it might actually go over 6 or 7 years of tax return. Look, to make sure you can get it right, we do have a borrowing expense calculator on the ATO website. And to use it, you've just kind of got to get all your make sure you've got your records and numbers there, and then you can plug it in and it'll help you to get it right. But we've also got a borrowing expense fact sheet as well in our investor toolkit on the ATO's website, which can help people to understand, even before they're purchasing a property, which of those borrowing expenses they can claim over that 5-year period.
And being a little bit of a home handyman, with a garage, like a lot of males, I have my toolkit. And I think it's good to emphasize to the audience that the ATO has a toolkit as well, as you've mentioned a couple of times. And we shouldn't be bashful in using that as an initial guide to what you can and can't do. So you make sure that you keep within those rules.
We'll put those links to the tax department's website in the show notes, Ken. Now, a minute ago, I asked you about the tax gap, Rob, but maybe you can offer some tips of how we don't get caught up under declaring our taxes and end up in that gap.
Yeah, so really good question, Michael. I think the way is just about people understanding their tax obligations, really. So understand your tax obligations as well when you make decisions as they relate to your investment property. So whether that's refinancing or redrawing from your investment loan, or whether that's making decisions around whether something's a repair or it's an improvement, are important. On loans as well, as I said before, you need to remember to apportion that expense over the whole life of the loan, and calculations can get complex as it goes on. And if you're redrawing funds and you're using them for private purposes, then you also need to think about that. So it's really just about people understanding the tax implications of any decision that they make as it relates to their property investment.
So, Rob, as a property investor, we buy property and we're holding it for the long term. We eventually are in a position where our rental income exceeds our expenses, as any good business eventually does. And it's time then to start thinking about paying tax on that. And I understand that we can go and actually ask, or the ATO automatically takes that tax out periodically for income that we're going to get, which isn't in our normal, can I say, wages system. So we're not lumbered with a big tax bill at the end. So that PAYG installments, as it relates to that non-wages income, which is the rental investment. So if
Yeah.
you can just explain a little bit about how that works and the options that are available.
Yep. So PAYGI, or pay as you go installments, is broadly a system that results in you prepaying smaller amounts of tax through the year to cover your expected tax bill. So kind of so you don't get tax shock, bill shock when you lodge your tax return, right? So it's a bit like the tax that you get withheld through your salary and wages. Realistically, the employer is withholding that on your behalf and remitting it to the tax office. So you're essentially paying smaller amounts through the year. So when you lodge a tax return, you don't have a massive bill. So kind of the same premise, just one's for business and the others around wages. So there's two ways you can get into the pay-as-you-go installments. There's automatic entry. So generally, if your business or investment income is more than $4,000 for the year, we automatically put you into the PAYG, or pay-as-you-go installment system. And this is to help you calculate, how much tax you got to pay through the year, so you don't have a big bill at the end of the year. And there's also voluntary entry. So if you're not automatically enrolled, you can choose to join the PAYGI installment system yourself. And look, this can actually be a smart move if you're expecting to have tax at the end of the year, because this can kind of just make sure that you don't end up with kind of a big bill at the end of the year, wondering where you're going to get the cash from. It just kind of means that you pay during the year. But once you've entered the PAYGI system, we'll send you a letter on your MyGov inbox explaining everything kind of that you need to know about that system.
And I think it's very easy for people to have that surplus money week by week, month by month, and they spend it. And like you say, there's a big bill shock at the end. And most of us don't have that discipline to siphon that money away. So I think voluntary is a good way to do it. And as you say, if the sums are large enough, they're actually forced into that system.
I guess my conclusion from our previous chats and today, Rob, is that the taxman isn't really after you. They just want Australians to do what their right tax obligation is, because the money, as you clearly said, is pooled and everybody gets benefit of it, providing the services that we need to live in the great society we do. I know there's a lot of information in the tax department's website, so I'm going to leave a couple of links in the show notes actually for people to read, and also there's some videos that you've got there as well. But if everybody does the right thing, if they follow their obligations, there shouldn't be any real concern about this, should there?
No, Michael. And look, that's really what we want to do as the tax office. We actually want to help people get it right when they lodge, right? The first time, they lodge their tax return, they get it right, and they don't have to worry about it to the next year. And so we do have a lot of information on our investors toolkit on the ATO website to help people to get it right the first time. Loads of fact sheets, loads of examples, and some videos as well. For those of you who prefer to watch than read sometimes, and, you can find it by going to ato.gov.au/investor toolkit. As I said before, we've got the new borrowing expense calculator. But, ultimately what we'd say to people is if depending on it's your personal choice about how you handle your tax affairs. But our website is a good point of contact and information, but you can also seek advice from a registered tax agent, and they can help you to work through what your tax obligations are. Obviously, that's everyone's personal choice as to where they want to go, but we just want to make sure people get it right the first time and help them to get it right the first time they lodge their tax return.
Anything you'd like to finish off on?
I think that very important point that you just raised, Rob, same as Dr. Google can misdiagnose because we don't know the right questions to ask. I think we've got to seek advice and go to professionals because it can be tricky, particularly with an expense. Can I claim it? Can I not claim it? And the date of which I made the expense could change its nature. So speak to a professional, use the tools that are available, get it right, but more importantly, get it right the first time, because that just smooths out the whole thing and allows a good investor to actually grow their portfolio with less heartache.
Fantastic. Well, Rob, thank you very much for, again, giving your time and for your team to provide those resources which we're going to share with everybody. It's the beginning of a new year. It's going to be an interesting year in property, but a lot of Australians, over 2 million, treat their property investments, or should be treating their property investments, as a business. And like all businesses, keep good records, get good advice. And if that's the case, you should hopefully benefit from it. Thanks for your time, Rob. Thanks, Ken.
Thank you.
Thanks, Rob. Thanks, Michael.
In a moment, I'm going to share my popular mindset message with you, but I just wanted to summarise the conversation we had with Rob, the Assistant Commissioner of Taxation. I guess the message is you've got to treat your property investments like a business, not a hobby, if you want to take charge of your financial future. And you've also got to get a good team around you, as Ken Race explained. And at Metropole, we specialise in helping Australians achieve financial freedom through strategic property and wealth advice. Beginning of a new year, are you going to make 2025 the best year for you? If you are, whether you're a seasoned investor or whether you're just beginning a journey, whether you're looking to buy a home, why not have our team at Metropole, our team of experts, help guide you every step of the way? We're much, much more than just a buyer's agent. We actually help you safely grow, protect and pass on your wealth. And while we're a large company, we're big enough to tip the scales in your favour, we're small enough to care. So we always start by putting together a strategic property investment plan for our clients using our deep market knowledge, our end-to-end services, and very, very powerful software. So we help you plan to become the person you plan to become, and then we help you implement the plan that we make together, and you have ongoing access to this very powerful software. Our track record speaks for itself. Metropole clients consistently achieve superior results, in some cases pretty exceptional results, and secure their financial future. A recent audit of the results of our clients showed they were 7.3 times more likely to own 6 or more properties than the average property investor, and we give you ongoing support. So why not have a chat with one of our wealth strategists? There's a link in the show notes, or just go to metropole.com.au, give us a call at 1300 Metropole. We'd love to be part of your ongoing wealth creation journey, but it starts with having an obligation-free chat with one of our wealth strategists.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I want to share with you the concept that success isn't easy. But that's where the value lies. Now, in my mind, in a world that celebrates instant success and quick gains, we can easily forget that anything worth having doesn't come easily. Of course, social media seems to tell us that you can just wake up in the morning and think good thoughts and it's all going to happen. No, it's not. Having been around the block quite a few times, I can assure you that real growth in your investments, in your business life, in your personal life, in your career is built on the foundations of hard work, of resilience and of patience. In my mind, it's the very struggle that you're going through that creates the value. The path to long-term success is supposed to be hard because each hurdle sharpens us, And each failure, it refines our approach. I've found that the challenges we face aren't obstacles to avoid, they're the way forward. Hard work builds resilience. So my message today in this short mindset message is that every time you push through a challenge, you're building something more than just skills or wealth. You're building resilience, a muscle that's going to help you bounce back when things don't go as planned. And let me reassure you, lots of times things just aren't going to go as planned. But the strength of resilience is priceless in the world of property investment and wealth creation, where the markets can turn, where the government can change its ideas, its policies, where interest rates can rise, where economies can shift. So the best laid plans are sometimes messed up. The more you've been tested and the more you're capable of navigating through tough times and emerging stronger on the other side, the more successful you're going to be. You see, struggle teaches discipline and patience. In property and wealth creation, nothing of true value comes without discipline and patience. No, it doesn't come overnight. You can't make millions of dollars in the next couple of years like some of those people are going to tell you on TikTok and Instagram. Because success isn't just a single great decision. It's the discipline of making consistent and thoughtful choices. You've heard me say before in other parts of my podcast that property, you can't just go off and buy it. It's got to be the physical manifestation of a whole lot of decisions you make and make in the right order. And just like you've heard Jim Rohn say and me mention, just like planting a tree, you've got to wait years to bear its fruit. Somebody's sitting in the shade of a tree today because somebody made that decision 20, 30 years ago to plant the seed. And just the same, wealth grows slowly and steadily using the power of compounding and time. But it's the hard work of staying the course and of riding the ups and downs and remaining committed even when success seems so distant. It's that hard work that creates the success. Another lesson I guess you've got to learn along the way is that embracing these discomforts leads to growth. Think of any major achievement you've achieved in your life, whether it's in investing or personal or professional. Chances are it wasn't easy. And that's the point I'm trying to make. Discomfort and challenges are essential for your growth. In property, smart investors don't shy away from the hard decisions or the challenging times. They view them as opportunities to learn and adapt and strengthen their portfolio. Embracing the uncomfortable is often where the most significant gains are made, not just in profit, but also in experience and wisdom, which is something that's going to get you to the next level. Smart investors know they need to do the hard things now, so they've got an easy life later, while the average Australian does the easy things now, so that they've got, well, not so that they, but that means they end up having a harder life later. I guess something else that you probably don't want to hear, but is true, is success feels better when it's earned. There's an irreplaceable sense of accomplishment in knowing that you've built something despite the odds. When it's hard, the reward is sweeter. Think about that feeling of seeing your wealth grow after years of persistence. Every risk you took, every difficult decision you made, every time you held on when others let go, that makes the reward worth it, doesn't it? So the hard path leads to a better outcome. If success were easy, everyone would have it, whether it's in property, whether it's in any sort of investment, in business and careers. If success were easy, everyone would have it. Remember, 92% of property investors never get past their first or second property. And that's after 50% of those who got into property have sold up. They sell up in the first 3 to 5 years. As I said, if it was easy, everyone would do it. So the mentorship message, the mindset message I want to give you today is it's meant to be hard. And when you recognize this, that's going to make it easy to get through those challenging times. The fact that building lasting wealth, securing financial independence, or achieving the legacy you want to pass on to other generations, the fact that it's hard also makes it more meaningful. You see, the difficulties are a filter, and they keep out those who aren't ready to commit or adapt or persevere. It's a journey, yes, and every tough step you're going to take is setting you apart from others who are not prepared to take those hard decisions, but also pushing you closer to your financial freedom in property. So my suggestion is you embrace the struggle. It's supposed to be hard because that's where the true value lies, not just in what you achieve, but in who you're going to become along the way. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen-to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?